Hi, everybody. Thank you so much for joining us and welcome to Blockchain Banter. I'm Jen and I'm here with Dr. Mark Richardson, project lead at Bancor and Carbon DeFi. Mark, normally we have Keith with us of Material Indicators. He wasn't available this morning and I thought I would really like to take this opportunity rather than cancel this week's show. Instead, really just kind of dive into Bancor and Carbon DeFi and kind of this, we speak more, I would say, to centralized exchange or to traders using centralized exchanges in terms of tools and things like this, right? But there's so much that we haven't covered on your end that I think our viewers can really benefit from. So I might put you on the spot a little bit. I really want to talk about Bancor and Carbon DeFi and really how they can take advantage of what it is that you guys have created in order to get ahead in trading, kind of really put some of these things that we speak about every week into place, right? So I did title this one "Bringing the CEX Trading Edge on Chain" because I feel with what you've created, they actually can. So I noticed a tweet yesterday from Bancor. They were kind of quoting someone that had, let me share my screen really fast because I have it here for us. Okay. So they say Base doesn't just have limit orders. And this was in response to someone who was kind of laughing at the fact that Base does not have limit orders and they just found it crazy that they don't. And Velocimeter Dex tagged Carbon DeFi, which is a product of Bancor, right? And said, we do. You can use graphene for limit orders for any standard token traded on all major dexes and more. So maybe first, before we go into what it is that you guys actually offer, graphene, for anybody that doesn't know, is a deployment of Carbon DeFi. So it's not just Carbon DeFi itself where users can find these, sorts of features that we'll be discussing, right?
Yes.
Okay. Then here. Yeah, so 2 licensed deployments, limit, range, and recurring orders. So this user's talking about limit orders specifically, which we talk about all the time, right? Keith is always saying, we want to set our orders. And I think pre-setting trades on chain is not as common as it is on centralized exchanges, right? So here is Bancor showing what Carbon DeFi has. A few, I would say, different options. Maybe you wouldn't mind just kind of giving us a brief intro into what each of these are. I know that, you kind of go into it a little bit more here. But it looks like range and recurring are mentioned in addition to limit orders. So how do limit orders work on Carbon DeFi? Are they like a centralized exchange?
It depends what you mean, like a centralized exchange. I think what characterizes a centralized exchange is the relative obscurity of the data and how they, are required to custody the assets, and whether or not they use clearinghouses and that sort of thing to process trades. Whereas a decentralized exchange is something that is openly advertised on a blockchain, and that anyone can interact with the liquidity there. But I think when a lot of people say centralized exchange, what they really mean is order book, which is a tool that I think most people begin using long before they start using AMMs. And the criticism that AMMs have received over the years is that they don't have, they only represent a specific subset of the order book, meaning that if you wanted to place an order to advertise an asking price or a bidding price that's very specific, generally an AMM won't allow you to do that, because the way that they're set up is to trade back and forth, right? It's meant to be a liquidity provisioning protocol, not a trading protocol. And so Carbon DeFi, it takes the opposite view. It is designed to be a trading protocol, not a liquidity providing protocol.
Okay. So in terms of limit orders then, if it's geared more towards traders, would you say, I mean, you're saying that it's more similar in that sense to a centralized exchange than it is to decentralized exchanges and what we've typically been accustomed to over the last X years?
Well, like, yeah, again, like I think that the labels centralized exchange and decentralized exchange are unhelpful because it's mostly
Okay.
referring to how orders are placed and how they're cleared. It doesn't say anything about what kinds of orders or what kinds of interactions you can have. Um, the I think that the distinction or the more helpful label is order book versus AMM. And since the very beginning, since even before Carbon DeFi was officially launched, and when I first just started discussing it in public, I said this is not an AMM, right? It's not it's not something that's meant for liquidity provisioning in the conventional term, meaning people that are sort of self-sacrificing, right? It's kind of a weird meme, in DeFi that liquidity providing is even treated as being a profitable exercise because even in traditional markets, liquidity providing isn't very profitable, or at least by itself. It's usually heavily subsidized by governments and the exchange itself in order to give professional market makers a reason to be there. Professional market makers or liquidity providers, these are synonyms, are also paid by the people, the institutions or token projects in DeFi's case, to provide liquidity. So the actual provisioning of liquidity as a financial instrument, historically speaking, has never been a profitable thing, and it's something that generally traders don't do. So Carbon DeFi is not it is not meant to be servicing that end of the market. Instead, it's looking more towards the people that are profit oriented.
Okay. So let's talk about range orders really fast. We're talking about an order book style, right? Range orders are not something that you generally find offered. I say centralized exchange, but let's go with order book, right? Generally offered or standard for an order book. But it's something that you guys have created and you offer on Carbon DeFi. I've previously said it's almost like how Keith says he'll ladder his orders, right? Why don't we? I'm going to kind of scroll to this one really fast. So here it says successful traders don't just go all in or all out. They scale in and out strategically. Let's talk about that one for a minute and what it is, what you're referring to with the scaling in and out and range orders.
Sure. So I wrote a blog post about this phenomenon a couple of years ago now. I think I called it something like Bitcoin, the original rage game or something. It's on the Carbon DeFi blog, I think, if anyone wants to read it. But it's basically, you need to think about what it means to even place an order at all. So for many people, they're just happy trading spot, which means that they're so desperate to get their hands on whatever the thing is that they're buying that they will just take the first price that someone offers them. But as any astute shopper will tell you, it's generally a better idea to have a look around and see if you can get a better price. When it comes to trading, that generally means placing specific orders and waiting for people to get desperate enough to take your price. And so there's two ways that this can work. One is that if the price of an asset that you're interested in is coming down, then you might place an order to buy it from someone as the market begins to express an interest in trading at a particular price point. So I'm not sure what the price of Bitcoin is today, but I know that the market is taking a bit of a pounding. And so you might say, look, I'm happy with my Bitcoin position. I think it's going to continue to improve over the next year or decade or whatever your time frame is. But you're still interested in acquiring more of it. But rather than the spray and pray sort of approach, you may have a specific price point in mind that will help you improve your cost basis acquisition of that asset. So for something like Bitcoin, maybe you've acquired, most, if not all of your Bitcoin below a certain price, let's say below $45,000. And you're happy with the profits that you've got now. And it's not really attractive to acquire more Bitcoin at today's prices. And so you might say, look, I'm convinced that the market will come back down to the price that I've previously acquired my Bitcoin at, and I'm happy to continue acquiring it at those prices. So you might advertise, look, I'm happy to buy Bitcoin from anyone who wants to sell it to me, but I'm not going to offer any more than $45,000 per Bitcoin. Now, what you're really doing there is you are, if you sort of do some soul searching in that decision-making process, you're basically betting that the market itself and the people in it aren't going to express asking prices on Bitcoin or bidding, and depending on your perspective, any lower than that point. And so if you do want to acquire more Bitcoin, you might think, well, if the market's pulling back that far, like how certain am I that it's going to get to exactly 45,000? Because I could offer to buy Bitcoin at that price, but then I have a risk that Bitcoin is going to continue to fall. So it might go down to 40 or 38 or 37. And, that means that the trade that you've made, no one would necessarily call that a bad trade, considering we're still above 80K. But it's definitely not as good of a trade as it could have been because, the market continued to go down. You could have bought more Bitcoin at a lower price. But then there's another risk, which is that maybe Bitcoin doesn't pull all the way back to that price, right? So if you're advertising just 45K, maybe Bitcoin comes back down to just 50 and then turns around and goes to $1 million or something. And then you might be disappointed that you were so aggressive in your bids because, also I should say pessimistic in your bids, because you then missed an opportunity to catch a significant upside. And so what's the answer here? And so a lot of day traders will tell you that they don't actually place one limit order, they place many, right? So in the case of Bitcoin, they might say, I'm going to start buying some Bitcoin at, let's say, 65,000, just a little. And then as the price continues coming down, I'm going to place more and more aggressive bids. So I'm going to buy more and more of the asset as the risk to entering at a specific point in the market cycle comes down. One of the people that is a very strong believer in that philosophy is someone named Ben Cohen, who's been like a technical analyst in the Bitcoin space for at least 3 or 4 years, probably even longer than that. And he will tell you, he's got these diagrams. He's very, very forthcoming with how he assesses the risk potential in Bitcoin markets. But basically, as his homegrown Bitcoin risk profile dictates, as the price is coming down and it looks like the bottom is in, he's happy to buy more and more of it. And as it looks like it's heading towards a blow off top, he sells more and more. And so that is essentially what scaling is. It's the refusal to put all of your chips down on a single price point. For people that are familiar with hedging, right, or hedging your bets, it's actually basically the same concept. So in a hedging scenario, what you're trying to do is manage your risk by accepting a slightly worse payoff for a significantly reduced risk profile. If we were, dealing with a seasoned gambler, you might say it's the difference between putting all of your chips down on like red at the roulette table, which has roughly a 50% chance of hitting, but only has a 2x payoff, or putting all of your chips down on 00, right, which has a like a 1/38 chance of hitting, or maybe more than that. I'm actually not sure how many cells there are on the
Something
roulette
a
table.
lot less than 50%.
Something a lot less than 50%, but the payoff is a lot higher. And that's exactly the gamble that you're making when you place a single limit order. So the ability to scale basically means that you're spreading your chips out over more and more price points, so that you're more likely to actually buy, something as the market capitulates, or sell it as it blows off top, close to, wherever that blow off top or bottom of the market point actually is. But it means that for the range that you've set your your liquidity over, that you are necessarily going to be buying some, higher than where the bottom of the market is, or selling some lower than where the top of the market is. But that's okay, because that helps you adjust your risk profile, and it's a very sober way to approach markets.
Mark, we have a comment here. Somebody said, they have a question I'm going to get to after, but they said it seems complicated. And so maybe we can take a step back. I want to try summarizing a little bit of what you said, especially in terms of how traders think. And we might not all even consider ourselves traders, right? But if you're buying anything and you're selling something, you're essentially trading it. So I might not be a trader like Ben Cohen is, or like you might be, or like Keith might be, but I certainly fall into the category because I do have my bags that I bought and I do plan on selling those one day, right? So I think I'll use myself as an example, especially in terms of these range orders. The last cycle I had my target price, my single target price. And when, this token gets to this price, I'm going to sell. And it never got to that price. And I was one of those suckers that held it all the way up and then all the way back down, right? Now I'm learning that there are different things that I should be doing and I could have done and will be doing this year, or, this cycle, to make sure that I don't fall into that same category again. The hopeless bag holder at the end of the day, right? So rather than my one specific price, this is where this is a limit order, essentially. The one specific price. Instead, I say, you know what, if I have my site set on $150, just whatever number, I'm going to start selling at 120 and I'm going to sell up to 170, something around, something along those lines. So as my token price is going up, I start selling a little bit of my bag at a time. And this is all automated with Carbon DeFi, right? So all I'm saying is I'm going to start selling at 120. I'm going to sell all the way up to 170 versus the one single price point that I've chosen, which is 150. I'm right so far, right?
Yes.
Okay. And rather than have to make multiple trades, if you're trading on an AMM, you would go in there and say, okay, I'm going to get 25% of my bag and I'm going to trade it at this price. Now, this is kind of where the tweak comes in because you're talking about slippage and MEV sandwich attacks and things of that sort. So we won't really get into that. But with Carbon DeFi, you don't have to worry about things. The price you set is the price that you'll receive, right? And you're not subject to those things. So in a sense, it's actually much easier because you don't have these hidden risks of using an AMM. Instead, you're just saying, I want to sell at this price, up to this price, and Carbon DeFi will handle the rest. Am I right?
Yes.
Okay. Blue Hawk, if you have other questions, specifically what it is that you think is complicated about this, I want to make sure that you understand it and you're not intimidated by the protocol, especially because there are so many benefits to using it. So please, add additional comments there if you have any. And Mark, I'm also going to ask you to kind of demonstrate how someone would go about creating a limit order or a range order. And as we continue learning about these different things, how they would go about creating those as well. So I'm going to move on to this next tweet here. Okay, so this is scaling. And this actually, so here, Blue Hawk, your 2 steps: define your price range, fund your order. You don't have to, divide it up into different percentages for each price point. Carbon DeFi will do that for you. And this is essentially what it looks like. Mark, you're starting at 55,000 in this example, buying down to 52. That is a buy range order. Okay, so this says, what else do successful traders do? Sell high, buy back lower, right? On Carbon DeFi, this meant manually timing trades before Carbon DeFi. This meant manually timing trades constant chart watching, and missing opportunities. So recurring orders are handled automatically on Carbon DeFi as well. And then it says one order, infinite cycles. So here's the image that you guys are showing. You're buying on the way down, you're selling on the way up, you're buying on the way back down again, you're selling on the way up. So let's talk about this one for a minute. It looks like two ranges in this specific example, but tell us about recurring orders.
Sure. So in general,
Mhm.
a trader will have a preferred cash asset or quote asset. In conventional markets before, cryptocurrency, that would have almost exclusively been the fiat currency that their trading account was financed with. The reason this is important is because when someone buys, for example, Tesla stock, rarely do they actually care about holding Tesla stock, right? It's always with a view to improving their wealth denominated in something like a fiat currency. So if you're buying Tesla stock or Microsoft stock or Apple stock or whatever, generally the motivation is because you think its value is going to go up. And after its value has appreciated, you're going to sell it and have more money than you started with, right? That's trading 101. Buy stuff at a low price and then sell it at a high price. But what traders know is that you don't necessarily have to do this just once. Often you can massively compound your profits by buying things as they dip, right? Hence the buy the dip idiom in cryptocurrency, and then sell stuff as it rallies. So a good example was just over the weekend when the Trump administration announced that there was going to be a strategic reserve for cryptocurrencies and certain assets. And you saw very quickly a lot of people started buying into those currencies.
Buy the news.
And yeah, you're supposed to sell the news, but yes.
That
The
came after.
the point is that a lot of people saw an opportunity as the market was in decline to buy one of those things and then flip it very quickly for a profit. So as stuff rallied, 15, 20% off of the news, they then sold the stuff that they bought after just hearing the announcement, which put them back in a better position to buy more of it as the price comes back down again. And so traders generally are in the habit of constantly buying stuff when the price is low and constantly selling it when the price is high, right? Traders aren't hodlers. They're constantly trying to improve their positions. And if you are doing this on a conventional order book, it can be a rather tiresome process. What I mean by that is that you may set up specific limit orders to buy things as the price is coming down. But after you have bought those things, it's then additional work to then go back to that exchange and then move the things that you've just bought out of your account and back into the order book to sell them again as the price goes back up. And similarly, as they're being sold, you then have to take the cash that you're getting for selling those things and putting that back in the order book. And then, this takes time and energy and attention, but it also, costs you money, right? Your profits aren't going to be as high as you might like them to be, because every time you interact with the order book on an exchange, they shave a little bit off the top as a part of the monetization of how that exchange operates. So where Carbon DeFi is different here is that it's a strictly automated process. So after you set up, where you want your buys and sells to be executed, it's a single transaction, and you never have to touch it again until you decide that you either want to adjust, where those price points are, or if you want to, if you decide to discontinue trading that pair or something. And additionally, Carbon DeFi doesn't charge you, the maker, any fees for doing this. The protocol has a fee component, but this is applied on top of the prices that you are asking for, and is therefore charged to the person who is buying those tokens or selling tokens to you. And so it's a much more effortless, much more efficient and a much cheaper way to trade with a relatively high level of sophistication. There's really nothing even on conventional centralized exchanges that that can offer a product like this, because this is something that really requires smart contract infrastructure to make work correctly.
So it's not really even bringing the centralized trading experience or like edge on chain. It's actually giving them an edge
Oh,
over
well,
centralized
yeah,
exchanges.
yeah, we're way beyond. Yeah, the stuff that you find on chain, Carbon DeFi included, is already offering tools and services that really embarrass conventional centralized exchanges. It's really just a myth, I think. Like, people always say, um, like, when is the DeFi paradigm going to be able to, hold its own against, conventional market tools and centralized exchanges? The reality is, they're really, in terms of technology and capability, we really have already left them in the dust. They're already eons behind us. And they have such inertia, right? And they're so immovable that it's very difficult for them to catch up. They have a certain edge in some cases. So, for example, blockchains are always going to be a little bit slower, and in some cases, blockchain transaction fees, where you have to pay gas to the chain on things like Ethereum mainnet, can be prohibitively high at times. But even then, like, Carbon DeFi exists on blockchains like Sei and Celo, and these are, a fraction of the cost of setting up even a single limit order or trading a single spot trade on Binance or Coinbase. It's already cheaper, and yeah, the the sentiment that DeFi somehow can't hold a candle to traditional centralized exchanges is a myth, um, as this
Do you think it's
product
because of the liquidity?
demonstrates.
Like, we talk about liquidity fragmentation so often in DeFi, right? And I know that you've kind of considered this a myth in a sense as well, right? Not
It
as big a thing
it is a
as
myth.
people, okay, as people tend to think, right? So, what about that in terms of, you look at one of these major centralized exchanges and they have hundreds of millions of dollars in there, billions of dollars. And then you look at a decentralized exchange or an AMM, and it doesn't have nearly the amount of liquidity. Do you think that comes into play? And where does Carbon DeFi fall in that?
No, I don't think it does come into play. I think that I wish I knew where these perspectives were coming from. I think that there are there are I'm reluctant to say thought leaders. Let's say that there are people that have large followings and command a lot of influence in blockchains and, decentralized finance and things, and they have a lot of clout. And when they speak, people listen and assume that what they're saying is true. And for a lot of those people, they do like to point to things like liquidity fragmentation, and they say it like it's gospel truth. The reality is, people have a very thorough misunderstanding, or at least these people have a very thorough misunderstanding of what it even means to have liquidity on chain. Ethereum mainnet has been more liquid than any of the centralized exchanges have been, for at least the whole time that I've been in cryptocurrency. And it's important to point out that when I say Ethereum mainnet has been liquid, it's because I consider the entire chain to be a single exchange. I think where people get the wrong idea, or where they can be misled, is that they pay attention to specific projects' TVL, for example, a specific project's volume, when really what you should be paying attention to is the TVL of the entire blockchain. And Carbon DeFi was really built with that realization at its core. So with Carbon DeFi, as opposed to normal DeFi protocols, it doesn't use the TVL, contained within itself to execute trades. It uses every available liquidity source on the blockchain that it is deployed on. So if you are using Carbon DeFi on Ethereum, you're not just trading with the TVL inside Carbon DeFi, you're trading with the TVL inside Uniswap, SushiSwap, Curve, Balancer. Every single DeFi protocol is plugged into Carbon DeFi by design. And this is true on every blockchain that it's on. So there are Carbon DeFi deployments on Base. There are Carbon DeFi, deployments on
Phantom,
Say, on
Mantle.
Celo,
Mm-hmm.
Phantom, Mantle, you know,
IOTA.
um, and that, and that absolutely flies in the face of this idea that fragmented liquidity is even a concept that we should be talking about. It really is just a boogeyman that I think some of the industries, let's say most blatant pretenders, like to dangle in front of us in order to sort of scare us into thinking that that blockchain hasn't fully arrived. It has. I think with respect to the competition between decentralized exchanges, DeFi, and CeFi and centralized exchanges, is more the convenience aspect of it, and that shouldn't be too surprising. I think, I hope that it's not too controversial to say that every single person that ends up on a blockchain must first go through a centralized exchange, right? There is no way, at least there's no convenient way that anyone can access to get their hands on things like Ethereum or Bitcoin or XRP or Cardano or whatever, unless they have an account with a centralized, trading cryptocurrency provider. And I think that that's really where it comes from. It has nothing to do with how competitive DeFi is versus conventional products, and everything to do with convenience, and the fact that there is a necessary funnel there. So if, in order to get to the peak of Mount Everest, you have to go by, Everest Base Camp first. And before that, you have to get to Nepal Airport. We shouldn't be too surprised that Nepal Airport is, more populated than Everest Base Camp is, and that's more populated than the summit is. Just because, everyone who makes it to the summit has to go through those points first. And I think that that's really what it is. And I think for years, most of the centralized exchanges have been making it, I don't want to say as difficult as possible, but they give you lots of reasons, or they try to give you lots of reasons to not leave the exchange. And of course they should, right? That's just good
Right.
business practice on their behalf. And so, when DeFi was becoming very popular in 2020, 2021 for things like, staking and, being able to lend your tokens out and earn interest and that sort of thing, we shouldn't have been too surprised that decentralized exchanges responded by saying, oh, we'll do that for you so that you don't have to use the blockchain, right? You can use our earn service or our staking service and so on and so forth. And as long as self-custody is not a problem for you, and in the wake of things like FTX, I don't understand why it's not more of a problem for a lot of people. But if it's not important to you, then there really isn't, too much of a draw, right, to leave your exchange, especially because most people don't really, don't really do too much. They might show up on their exchange 3 or 4 times a year, buy a few things and call it a day. But it's really the super users, right? The people that are very passionate and committed to, maybe not just cryptocurrency trading, but cryptocurrency as an ethos, right? Or as I'm reluctant to say lifestyle, but I think you know what I mean, right?
I do.
If they feel like they belong to that particular counterculture movement, then they are going to be compelled, to leave the centralized exchange and join DeFi and do things on their own and explore blockchains for themselves. And I think those are the bottlenecks. It's got absolutely nothing to do with product competitiveness, because from where I'm standing, I really can't think of any good reason why anyone would use a centralized exchange over decentralized alternatives.
What about the options that they have in terms of tokens to trade? When you're talking about carbon DeFi versus
Well,
a centralized exchange.
well, again, yeah. So Carbon DeFi offers every single token that's ever been released on Ethereum, right? So the decentralized exchange I use, and again, I have to use a centralized exchange to get between cryptocurrencies and fiat so I can pay my bills. And the exchange that I'm using recently boasted that it has 8,500 different tokens, available, which is nothing. There's 11 million tokens available to trade. Now, not all of those tokens I think should be traded. Some of them are malicious,
What
some
are
of them
the
are dangerous.
exceptions? Tax tokens, I believe, are an exception, right?
Not necessarily. So
Okay.
the contracts will accept any ERC20 token. The problem with tax tokens is that they are they're generally incompatible with smart contracts. And so people say, yeah, but I traded them on Uniswap and so on. You just got to set the slippage, and that's all well and good. But the problem is that it sets up a like a bank run type situation where people think that the trader is paying the tax on these tokens, but actually it comes from the liquidity providers. And there is a mismatch, right? So ever since Balancer v2, smart contract infrastructure around AMMs has been set up so that there is a single vault where all of the tokens are located, and the liquidity pools are really just an abstraction, right? A logic layer on top of the vault that tells it how its balances should change. And that means that if the liquidity pool balances are changing in a way that is different from how the vault tokens are changing, then you can end up with a like let's say an erroneous accounting ledger. And that's exactly what tax tokens do. Every time they're traded, they take more tokens from the central vault than the liquidity pool was expecting to lose. And so you end up with a situation where not everyone can withdraw their liquidity. And there are lots of examples of this, right? Every single tax token has this issue. There are no exceptions. All tax tokens fail, the most basic of sanity checks when it comes to not just DeFi protocols, but also lending protocols and other DeFi things. So you can do it on Carbon. It just means that the system will slowly lose track of of your balance the same way that any smart contract infrastructure would. So as long as you don't care about that, then then it's not a big issue. So who would care and who wouldn't? Um, Obviously, a trader, someone who is trying to trade these things, for personal gain, would care about something like that, especially if they're going to do it over a long period of time. So if that's you, then you shouldn't be providing liquidity with a tax token. But in general, I don't understand why anyone who's profit motivated would trade a tax token whatsoever. But if you are a tax token issuer, it probably doesn't bother you too much, because you're setting these things up for other people to trade all the time, and those tax tokens are being streamed back at you, which is probably why a lot of AMMs still have tax tokens available to trade on there, because it's the person who issued the tax token, right? The person who created the tax token contract that is the liquidity provider, and their revenue source comes from people trading it thereafter. There's another couple of tokens that have like general compatibility problems with DeFi infrastructure other than tax tokens. One is rebasing tokens. But again, it's not necessarily that rebasing tokens are an issue here. The problem is that with rebasing token, you get a similar problem, but in the reverse direction. This time, instead of the smart contracts token vault having too few tokens to give people, it ends up with too many, but it has no way to know who those tokens belong to. And so you end up with first dust accumulating in the vault that no one can withdraw. And then after that, you end up with, it might snowball and you end up with a lot of tokens there. There have been rebasing tokens over time that have had like a switch in there, or like a callback function or hook inside the token that can switch the rebasing off. And I have never understood how that's helpful, because that's essentially what happens when you provide liquidity with a rebasing token anyway. So you can provide liquidity with a rebasing token. Again, if you are the issuer of that rebasing token, not such a big deal. Whereas if you're, someone who's invested in that token, then putting it in a lending protocol or putting it in an AMM is generally a very bad idea, because those rebasing, the rebasing value will be unable to arrive at you. And then the last one is what's called a hook token, or tokens with callback functions. And there have been many examples, over the years. I think the original Chainlink token, I think, had a hook in it that was taken out or obfuscated. And there have been a bunch. And these also have issues because people can spam certain functions on your behalf as you're trying to interact with the smart contract. So these have like very severe, security issues associated with them. And in general, a token with a hook equipped on it, you shouldn't be putting anywhere near a smart contract. So these are the general exceptions, but this isn't Carbon DeFi specific. These apply to every single DeFi contract on any blockchain.
Mark, we have about 10 minutes left. So I want to, just to be safe, we'll say no tax tokens, no rebase tokens, and no tokens with hooks, right? Somebody is asking about, can Carbon work with tokenized assets? I'm thinking they mean...
Yes, of course.
Yeah. Okay. Well, Blue Hawk, you have your answer. I also have a question about, speaking of tokens, about Bancor's token. I'm thinking you probably won't be able to answer that one, though.
Well, what's the question?
They're talking about the supply of BNT.
Okay. What's the question?
BNT has become more scarce than ETH itself being deflationary. Is there a reason for this burn? Why the supply drop?
So it's why the supply drop. Yeah. So yeah, as Jen is trying to protect me from, this is something that I can't speak about in public. But it's also not a secret, if you are interested. This is something that the Bancor DAO has been actively engaged in over the last couple of years. And yeah, the short story is, when Bancor V2.1 was released, there was a liquidity mining program associated with, which was very, very trendy at the time. I'm sure Jen remembers how hot liquidity mining was.
No, it was ridiculous. That was DeFi summer, and it was like everywhere. I mean, it was a big deal.
It was a big deal.
Bancor's, was a big deal.
And Bancor's was a big deal. And the DAO got very excited about it, and basically pushed that system to its limits. And then it kind of switched gears and enacted a policy to basically reverse that process.
Counteract that.
So counteract it. So all of the tokens that were emitted should eventually be bought back from the market and destroyed.
Are you able to speak about whether or not they have?
Well, I mean, what I can say is that the DAO has made these decisions and voted on them, and we have a responsibility to make sure that the protocol is governed in accordance with the DAO wishes. So right. Of course there are processes in place to do this. The first one to be implemented was something called the Bancor Vortex, which is, we're talking about several generations ago now. And the Vortex is now evolved to become a multi-chain, funnel for excuse me, for bringing value back to Ethereum mainnet. And once
what do you mean bringing value?
Well, okay, so all of the Carbon DeFi protocols deployed on different chains accrue fees through the mechanism that I described earlier in this call. And those fees are eventually bridged back to Ethereum mainnet and used to offer to the market in return for BNT. which is then removed from circulation permanently.
This was another DAO governance, a DAO proposal, which then turned into an approved vote, right?
Correct. Yeah, this is, I'm just describing policies that the
DAO.
DAO has enacted. And so, yes, those mechanisms have been built. And yeah, it's not something that I can, you know,
speak too deep into.
I can't. Yeah, it's difficult to talk about for obvious reasons, but
That's
yes,
okay. We can move on. I think we've answered their question. Blue Hawk, if you have additional questions, please go ahead and share them. And if Mark is able to, I'm sure he'd be happy to answer. Mark, we have about 5 minutes left. It's unfortunate because I see your screen here. Instead of, let me pull you up here. I know you have you do have the trade page open. So let's speak about this. This probably looks more familiar to traders who are using order books than it does to, traders or anybody on chain using an AMM, right? But because we have 5 minutes and I do have one more question for you from a viewer, talk us through if somebody is coming to Carbon DeFi for the first time. They just learned about range or limit orders, range orders, recurring orders. How is this, especially considering somebody said this seems difficult, right? Walk us through and show us what the process is.
Well,
let's say I want to make a trade.
Okay. Well, Jen, what do you think the Bitcoin market is about to do?
I think it is going to, I think everybody would hate me if I said went down. So I'm going to be bullish and I'm going to say, I think it's going to go, what are we at, 91? Is that what it says?
We're at 91,292.
Okay. I want to sell my Bitcoin that I have at 95 because I think it's going to go up and then it's going to go back down.
Okay. So let's start
with
my
TBTC.
Yeah. So yeah, TBTC is it's just for anyone who's paying attention. Bitcoin is obviously lives on its own blockchain, and that blockchain unfortunately can't support smart contracts, at least in the conventional sense. TBTC is a wrapped version that exists on Ethereum, and it's one of the better, more secure versions of it. Okay, so TBTC, it has a price that is roughly 1-to-1 with Bitcoin because of that wrapping process. So we're currently at 82,854.
Oh, we're at 82. Oh,
yeah, we're at 82.
Okay.
We haven't actually closed this candle yet. Okay. So yeah, we're on the way down.
I want to change it. I don't want 95 anymore. I think I want to sell it 87.
87. Okay.
Yep. So I'm watching the charts. I'm waiting for it to hit 87 so that I can sell.
Okay. So you can see here that we've got the limit or range button here. And so this gives us this horizontal line where you're literally just choosing the price that you want to sell something at. So there's your 87. And here is where, if you don't just want to play around with this line, you can actually put in, the exact number that you would like to sell at. Now, you can also put in, any amount. If you happen to have $1.17 billion, then Carbon would very happily accept that TBTC from you, and it would advertise it at that price. So what is it that we're doing here? We're saying that when the price catches back up to 87, this is where you want to sell it at. And that's all the protocol is going to do. Now, there's no keepers. There's no, it doesn't require the system to really do anything, because all it's doing is advertising your price to the blockchain in much the same way that an order book on Coinbase or Binance advertises its prices to the people that fill orders there.
Now, Mark, I first said I wanted to sell at 95, and then I said, at 87 because I'm afraid it won't get to 95. So let's use that example. Now I'm rethinking. Well, you changed my limit order, but say I want to go to a range now. I feel safer at 87. My 95 was my real target, right? So how do I go and say, you know what? I'm going to take advantage of the range order and start at
You had your hard
87 and go ahead.
Yeah. So you had your, I can feel your indecision flipping back and forth between these things, because part of you is hopeful that it will go higher, back up to like 95, and part of you is convinced that actually we might not make it that high before the market trends down farther. So what you can do is, like I said, hedge your bets, and so we can set a range between 87 and 95, and what this will do is offer little pieces of the TBTC that you're putting here, and people can chip away at the TBTC that you've created there as the price goes up.
Mark, I know do you have a hard stop in 2 minutes?
Yes, I do.
At the top of the hour. You do? Okay.
Unfortunately.
Okay.
So yeah, but that is how a range works, and you can make this arbitrarily precise. Now, compared to a traditional order book, you could only have, if you could imagine, setting up a bunch of these, single limit orders, and if you were really enthusiastic, I don't know, you might set up 20 or 30 or something like that, especially if you've got $1 billion worth of liquidity. I don't know, maybe you'd set up like 50 or 100. But on Carbon DeFi, it's infinite, right? This is actually continuous liquidity. And I know that sounds, abstract, but it is actually how the protocol works.
Okay, one more question. Can you just flip to recurring so we can at least see what that looks like? Recurring is the buy low, sell high on repeat. And just for everybody, a little recap on that also. You are creating your buy order, you're creating your sell order. These two are linked together. You can fund one side or both sides, depending, right? When you asked me what I thought Bitcoin was going to do, I wasn't sure. I could prepare for both situations if I really wanted to, by funding my buy order with a little bit of USDC and my sell order with a little bit of my TBTC, and be prepared for whatever the market happens to do. But this continuously will buy low and sell high as long as I have funds in my orders to do so, without any charge for each trade to the maker. Correct? So whoever creates this strategy pays that one-time fee. It's the network gas fee, and that is the extent of their fees, unless they want to go in and edit their orders. So they can go in, they don't have to cancel it and do all of this. They can go and edit their prices, right?
Correct.
Kind of trying to quick sum it up because we have to go. Okay, you have to go. I do have a question from someone. We're going to have to get back to that. I know Bancor created the constant product AMM in 2017. You then created concentrated liquidity in 2020. Now you introduced asymmetric liquidity with Carbon DeFi in 2022, right? They're curious what's next. If you have any new, features being developed or anything of the sort. So can you just anything?
Always developing your stuff, but I don't talk about it publicly until it's audited and ready to ship.
Okay. Well, maybe something that you're always working on something. We will take that. Thank you, Mark, so much. I know you have to run. Thank you to all of our viewers as well. Mark, I'll see you next week. Thanks, guys.